In the 12 months leading up to June 2023, the Office for National Statistics reported that London saw a net internal migration loss of just over 86,000 people. If you consume popular media, this singular statistic is frequently weaponized to declare the death of the capital. Yet, when we dissect the underlying datasets, this dramatic narrative collapses. We are not witnessing an exodus. We are observing a highly predictable, data-driven redistribution of wealth and life stages that fundamentally reshapes how we must view the housing market. Understanding why this exodus narrative is fundamentally flawed requires looking at where those 86,000 individuals actually went. Headlines suggest a mass flight to distant rural idylls or entirely different UK cities, but the ONS migration data tells a concentrated story. The vast majority of these departures never severed their economic ties to the capital. Instead, they simply crossed the M25 into the commuter belt. This is a workforce recalibrating its housing needs while firmly maintaining its primary income source. The implications of misreading this regional migration are profound for anyone navigating the housing market. When buyers and developers assume a city is losing its core demographic, they misprice risk and misjudge future housing demand. If you believe the capital is shrinking, you might expect a collapse in central property values. However, acknowledging that this movement is a structured expansion into the home counties completely changes the investment thesis. The economic engine remains intact, simply driving demand across a wider geographic footprint. The mechanics of how this data is captured reveal exactly why it is subsequently misinterpreted. ONS internal migration datasets track changes in GP registrations to map movement between local authorities. When a family moves from Wandsworth to Surrey, they register as a statistical loss for London. In reality, they are likely still commuting into Waterloo 3 days a week and relying on the capital's job market to pay their mortgage. The statistical boundary is rigid, but the economic boundary is entirely porous. Comparing the financial footprint of a Zone 2 apartment dweller with a commuter belt homeowner reveals exactly why this dynamic exists. A buyer trading a 1-bedroom flat in Islington for a 3-bedroom house in St Albans is executing a classic arbitrage of space versus proximity. They are leveraging the high equity generated within the city to secure a different lifestyle asset. The capital acts as an incubator, generating the wealth required to sustain property values in surrounding commuter towns. Broader macroeconomic factors, specifically transaction taxes, heavily influence the timing of these transactions. Stamp duty land tax, or SDLT, is a tiered tax on property purchases in the UK that significantly impacts moving costs. Because SDLT heavily penalises frequent moving, buyers are highly motivated to make long-term, definitive leaps. Instead of moving from Zone 2 to Zone 4, and then eventually to Zone 6, families are incentivised to jump directly into the commuter belt to avoid paying this tax multiple times. The shadow of SDLT still loomed over higher value transactions, pushing buyers to maximise their purchasing power in a single move. According to ONS data from the third quarter of 2023, local authorities bordering London, such as Dartford and Elmbridge, saw immense proportional influxes of former London residents. These areas offer the precise blend of increased square footage and manageable commute times. The numbers clearly show a targeted strategic migration, directly contradicting the idea of a panicked dispersal across the UK. This requires rethinking our fundamental definition of what constitutes London's population. The traditional view treats the capital as a static container that is currently leaking. A more accurate, data-backed perspective views London as a dynamic escalator. Young professionals arrive, driving intense rental demand in central zones. As they build equity and form families, they step off the escalator into the commuter belt, making room for the next wave of arrivals. The city is successfully exporting its mature demographics. Mortgage mechanics further facilitate this specific type of regional expansion. Consider loan-to-value, or LTV ratios, which represent the size of a mortgage compared to the total value of the property. When London homeowners see significant capital appreciation, their LTV ratio drops, giving them substantial unencumbered equity. This equity is the primary vehicle making the leap to the commuter belt possible. They extract wealth generated by the capital's market and deploy it into the home counties. Because that equity transfer is so potent, a distinct ripple effect emerges in regional property markets. The influx of London capital into the commuter belt raises the baseline pricing in those target towns. Local residents in places like Sevenoaks often find themselves competing against buyers armed with central London equity. This dynamic proves that the exodus is actually an aggressive expansion of the capital's financial influence. Departing residents possess the financial firepower to continuously reshape the entire southeast. Viewed through the historical context of urban development, this pattern is entirely unoriginal. In the post-war era of the 1950s and 1960s, the expansion of the railway network drove a massive wave of suburbanization. People left the inner city for the newly defined commuter belt, yet nobody claimed London was dying. They rightly understood it as structural evolution. Today's migration data reflects the exact same process, merely updated for an era of hybrid working and digital connectivity. The echoes of that market phase still resonate loudly in today's housing data. Just as the post-war railway expansions redefined the map, the normalization of working from home 2 days a week has simply stretched the acceptable commute time. A 90-minute journey is entirely manageable if done only on Tuesdays and Thursdays. Therefore, the boundary of what we consider the commuter belt has expanded, capturing towns previously deemed too distant. This is a technological shift, not a demographic collapse. At the area level, the architectural demands of a family leaving London dictate exactly where they can go. They require 3 to 4 bedrooms, a garden, and proximity to highly rated schools. Central London fundamentally lacks this specific type of housing stock in affordable volumes. The move to the commuter belt is a pragmatic real estate transaction driven by supply constraints, rather than an ideological rejection of urban living. The housing demand has merely evolved into a different asset class. Comparing the value proposition of these two distinct asset classes makes the logic of the migration undeniable. A budget of £800,000 might secure a cramped terrace in a gentrifying pocket of Zone 3, or it could purchase a substantial detached home near a mainline station in Hertfordshire. For a professional couple, the utility of the latter far outweighs the former. The ONS data is simply capturing thousands of these rational value judgments aggregating into a macro trend. The most dangerous thing an investor or homeowner can do is align their financial strategy with a flawed media narrative. By debunking the myth of a dying city, the data reveals a highly functional ecosystem where the center generates wealth and the periphery provides living space. If you sell off London assets because you fear an exodus, you are betting against one of the most resilient economic engines in the world. Understanding this symbiosis is key to accurately pricing property. Looking ahead, this data-driven reality will continue to dictate infrastructure and housing policy. As long as the capital remains the primary hub for high-yield employment in the UK, the commuter belt will continue to serve as its vital release valve. We will likely see further densification around key transport nodes in the home counties as developers attempt to capture transitioning Londoners. The demand for housing is not evaporating. It is flowing along paths guided by space, tax, and equity. Ultimately, stripping away the emotive language of an exodus allows us to view the housing market through a lens of pure utility. The ONS internal migration datasets do not chronicle the decline of a great city. They map the life cycle of its inhabitants. By recognizing that regional migration is a feature of London's success rather than a symptom of its failure, you gain a distinct analytical advantage. You stop looking for a market collapse and start tracking where the capital's immense equity flows next.